Okay, in this video, I just want to cover off lease options. It's a delayed purchasing strategy that can be used, and whilst they're probably not as easy to find as serviced accommodation deals or HMO deals, they're still a powerful tool to have in your armory. And I think when you're going on viewings, you can, especially when you're going on BRR style B&B type viewings, you can always have this tool in your armory, and it really helps to potentially win deals over. You know, I've had deals that I've gone to view for a certain strategy, but then realized that it'll suit a better strategy. So I think it's a good idea to know how each strategy works. So in brief, a lease option is a delayed purchase. So let's assume someone has their property advertised for 120,000. Okay, but the reason they've got their property advertised for 120,000 is because they bought it for that. And what I find at the minute is pretty much anybody that bought a property around 2004 to 2007 seems to be in a prime position for a lease option deal. More than likely because this was the height of the house prices before the crash. There were 125% mortgages getting given out, 100% mortgages getting given out. So people are highly geared, and quite often they're on interest only, so they haven't been paying them off and they're stuck. But right now, that property is only worth 100,000. So it's no surprise that at 120,000 pounds, the property's been sat on the market for weeks, months, you know, with no action, no viewings. I might have had a few viewings, and more than likely they'll be getting offers around this sort of level, which aren't acceptable, because then they're going to have to put 20,000 pounds out of their own pocket into the deal to be able to release their mortgage. So it doesn't work for the person who has got the mortgage, so they can't go anywhere. Now, there are other instances where, say, for example, lease options will work for people that maybe have inherited properties and they don't want to sell them because they don't want the capital gains tax, or they want to maximize the sale price. So, you know, they don't want to sell it off cheap, but at the same time, they don't want to be landlords and they don't want to run the property. There's a lot of people that do not want to be landlords. They don't like confrontation. They don't like the idea of it. They're not very good at managing money, you know. So a lot of people become accidental landlords and they don't want to be. And this is where lease options can come into play. So there's various reasons. And again, if you start just exploring this a bit more, you will start to come across the right type of people. But typically I find that they are people stuck in the mortgages because they bought around this time period, people who have inherited properties or become accidental landlords. Or people that are maybe possibly going through divorces. So 100 grand is all the property's worth. That's all that the market value is going to give right now for that property. So what do we do? How do we structure this deal? So we would go along and basically say to the prospective vendor that we're quite happy to pay the 120,000, but we only think that it's going to be worth 120,000 10 years from now. Okay. So in 10 years from now, it's going to be worth 120,000. And I'll give you that 120,000 in 10 years. So we have what we call an option to buy in 10 years time. Now, some people might say, well, if it's only an option to buy, why would they commit to it? Well, worst case scenario, they're getting their problem solved, which is the fact that they don't want to run the property for 10 years. And if I then decided I didn't want to buy it, they've still got the asset and they will have had the capital growth over that period. Some might argue that it might not grow, but property tells us that over time it does. So they're going to get the capital growth, and then they would more than likely be able to put it on the market for 120,000 in 10 years time, and it would sell straight away because that's what it would be worth, or it would sell fairly quickly. And no one's going to overpay. There's too much data online now for people to overpay for houses. So we give option buy for 10 years. Let's just assume, for argument's sake, they've got a £300 a month mortgage on this. And the property is a nice 3-bed semi that we could rent out for £750. Okay. So what we agree is that in 10 years time, we're going to buy it for £120,000. And in the meantime, we're going to run the property as though it's ours. So we will cover all maintenance. Boiler goes, up to us. Roof goes, up to us. You know, we become effectively the owner. All responsibility is ours. And then what we would then do is we're going to cover their mortgage. So we're going to pay them £300 a month to the vendor for 10 years. On a side note here, we just need to check a few things. I don't want to go too much in detail of this now, but things like mortgages, when their fixed rates end, you know, when their redemption penalties are, all that sort of stuff we need to find out before we get into these type of deals. The sort of nuts and bolts of the fine detail are important, but just to keep it simple, we're going to pay the vendor £300 a month, and then we can just single let that at £750 a month. We'll probably pay for a bit of insurance, which could be about 20 quid a month. We'll pay, so the property's going to stand as £320. We're going to rent it out for £750. So we're going to make, what's that? 3, 4, 5, 6, 7. So £320 a month. Sorry, £430 a month. That's a bit off this one. Profit per month, just shy £5,000 a year. Maybe, you know, a bit of maintenance might be involved in there, but you're going to, you know, do it for 10 years. So, you know, all in all, this deal's worth £50,000 over a 10-year period. Another property into your portfolio and another cash flowing unit into your revenue every single month, which is the idea of the game right now, is just to get as many of them as possible. We could take it one step further and super rent this property, depending on where it is, whether it would fit, etc., etc. So I have lease options that I run on serviced accommodation, for example, and they work incredibly well. Obviously, we pay the mortgage payment, which is low, and we're maximizing the rent because we can super rent it. So that is how lease options work in brief. If there are any questions on it, dive into the Facebook group and ask away. Don't forget to tag me in your post and do your research. Get back onto your spreadsheets that you've been using for the previous researches on your serviced accommodation, HMOs, etc., and do some lease option research. Find out where your area is and start prospecting for lease options, because they are a fantastic opportunity to build your net wealth for the future. Obviously, it's not instant, but you are securing that net wealth for the future, but you're generating cash flow for now.